This past Wednesday was declared a National Day of Mourning to commemorate the passing of former U.S. President George H.W. Bush. In conjunction with that day of mourning came a rare occurrence, the closing of the U.S. stock markets. In this morning's U.S. Bank Economic 360, U.S. Bank's Senior Vice President Mike Denneman joins Business Courier editor Rob Dahlmeyer in the studio to talk about market closings and why they're so rare. Mike and Rob.
Peg, thank you. Mike, thanks a lot.
Good morning.
Here. So obviously with that funeral, it did sort of clicked in with a lot of people.
Sure.
The market's not closed very often.
No, it was a noteworthy event to have the capital markets closed on such short notice. Doesn't happen very often. Now, of course, it is traditional with the passing of a former president to have the markets have a holiday, although that doesn't happen very often. The last time was more than 10 years ago in January '07 for former President Ford. But beyond that, it takes a pretty major event to close the markets on short notice. In fact, it's only happened twice this century, back in 2012 when Hurricane Sandy hit New York City, and then, of course, after 9/11. So yeah, what we saw this past week was certainly unique.
Why is it so hard to close that? Like, why does it take something this big to close the markets?
Yeah, so it's one thing to say we're going to close the markets, right? But then to actually make that happen is a big undertaking, right? I mean, think about all of the business that's transacted in the U.S. capital markets every day. I mean, a busy day for the New York Stock Exchange is more than 1 billion shares of stock. In the U.S. Treasury market, we're talking hundreds of billions of dollars of bonds traded. So if you close the markets unexpectedly, that's going to send a ripple effect through the global economy. So not something you want to do frequently, not something you just want to do on a whim. So obviously this past week was a big deal, and rightly so, for the passing of President Bush. But you know, as you and I were saying just before the program, while unexpected closings are rare, holiday closings, on the other hand, far more frequent.
Yeah, and that's what I wanted to ask you about, where it's that time of year. So talk to me about holiday closings.
Sure, and so there are quite a few this time of year. As most people would expect, the market is closed for major holidays. And so it was closed on Thanksgiving. In a couple weeks, it'll be closed for Christmas Day. Week after that for New Year's Day, and then a couple weeks after that for Dr. Martin Luther King Jr.'s birthday. So that's a whole lot of market closings in a short period of time, although, you know, probably not unexpected. Most investors would anticipate that and plan accordingly, but there is a little twist in there, and that is Christmas Eve. So Monday the 24th is not a market holiday, but it is a shortened trading session. So both stock and bond markets close early. For the stock market, for instance, typical trading is 9:30 in the morning to 4 in the afternoon. On the 24th, it'll stop at 1 in the afternoon. So just something to be aware of if you're planning on doing some last-minute stock shopping for stocking stuffers or something. Just make sure you get that done early in the session.
Well, it is fascinating, and like you said at the beginning, this doesn't happen very often.
No, it doesn't.
Thanks for being here.